could you quickly cover the basics of evaluation?
Sure. The basics of evaluation and I'm going to go with Main Street because they're a little different on middle market. But I'm going to go with the basics of evaluation on Main Street. You have something called SDE, which is seller's discretionary earnings. Okay. And you calculate that by starting off with the business tax returns, which we all know have been mitigated, right? Because everybody wants to pay the lowest amount of taxes they can. So you're going to start with the taxable income on the tax returns, and then start adding back expenses that were not necessary for the successful operation of the business. For example, let's say the business owner has an accounting practice and they're writing off car payments. They work out of an office. They're not making any deliveries, so yes, they can expense their car, they can expense their fuel, they can expense all kinds of auto expenses, but those are not necessary for the operation of the business. So let's say they have $20,000. Let's say their taxable income on the tax return is $80,000 and they have $20,000 in auto expenses, which we can add back. So now we have seller's discretionary earnings of $100,000. And then maybe they paid their kids' college tuition through the business, and they paid the boat slip through the business, and the repairs on the beach house or the mountain cabin, and all these other things. Now we have like another $100,000 in add backs. So now we're up to seller's discretionary earnings of $200,000. So once you determine the SDE, or the seller's discretionary earnings, then at that point, there is a multiple applied to it, right? So if you want to write down a formula, basically the basic formula is that your value, your business value, is going to equal your earnings times a multiple, right? Your earnings is either going to be SDE or EBITDA, depending on whether you're valuing Main Street or middle market. And then your multiples are going to change depending on the level of SDE or EBITDA and the industry you're dealing with, and a few other factors. So valuation, in my mind, is really part art and part science. Calculating the SDE is the science part. It's just math, right? You're taking a look at the expenses. You're saying, okay, let's start with this taxable income. We're going to add, let me go back. As far as EBITDA goes, it's earnings before interest, taxes, depreciation, and amortization, right? So we are always going to add back any interest that they've paid, any state taxes that state or federal income taxes that they've paid, that they've expensed out, right? You can't add back what hasn't been expensed out. So as you're going through and making these adjustments to calculate your SDE, first you're looking at your taxes, depreciation, amortization, and interest. You're adding all those back. Then you look for one-time expenses. Let's say the business moved, it relocated, and it cost $12,000 to move the business. So that's not a normal recurring operating expense. It's a one-time expense, so you would add that back. Ultimately, what you're trying to get to, and when you're determining a business value, you're trying to get to operating income and operating expenses, because that's what a buyer is looking at. That's what they're interested in, is how much operating income am I going to be able to generate from this business, and what are my operating expenses going to be? Because everything else is discretionary to the owner. And they can pay themselves, they can pay their family members, they can, you know, pay for their toys, right? Their luxury toys or whatever. So it's really operating income, operating expenses. And that's what you're trying to determine. Yeah, Dick.
So on the IRS tax returns, there's a line item there that says stockholders compensation. What do you do with that?
Officers' compensation is added back. If they're an S corp, then you are adding back also one officer's compensation. Because
Right.
again, we're trying to, in Main Street in particular, you are dealing with primarily owner operated businesses. And so we want to determine what are all the dollars that are available to that seller or at the discretion of that seller, of that owner. And so, yeah, so you will, and that's the difference between EBITDA and SDE.
Yeah.
So EBITDA is your earnings before interest, taxes, depreciation, amortization. SDE, your seller's discretionary earnings, is the same thing. It's EBITDA plus one officer's compensation.
And distributions, right? I mean, there's distributions sometimes too. Like we have this, I think I talked to you about an engineering company that we're listing. We did just listing. But anyway, they had, guy was pulling out quite a bit of money, but he also had 50,000 a year that he was not in dividends, but in disbursements. And my understanding is, well, that would be a discretionary thing that would be tacked back onto the bottom line.
Where would you find your distributions, or as you call it, disbursements? Where do you find them?
Tax returns.
Huh?
They were in the tax returns. So it comes in on his reporting, tax returns.
Right. So, okay, so your tax returns are a result of your financial statements, which are your income statement or profit and loss statement and your balance sheet.
Uh-huh.
And so, again, it goes back to, if it hasn't been expensed out, then it cannot be added back. And most of the time, your distributions are going to be on your balance sheet, not on your. So it's cash that's being moved from assets to equity. It's not going to have been expensed out, so generally you're not going to add it back.
Okay.
Same with, let's say they have let's say they own the building they're in and they're paying, or even they don't, I mean, but they're making, well, if they're making mortgage payments, then a lot of times they will, if they're running that through the business, they're running the entire thing through it. But let's say that the corporation, they have an S corporation, the corporation owns building. So the payments that they're making every month, a portion of it is interest expense, right? Because if you're paying a mortgage, you've got principal and interest. So a portion of it is interest expense. And what should happen, if it's being done correctly, is you'll see the payment being split, so that even though you might have, let's say $1,000 went out, but of that $1,000, maybe $950 is interest expense, and the other $50 is really decreasing the balance sheet, the liability due for a long-term note on the balance sheet. So, so what you would add back, well, in that case, you're not going to add anything back, but if you were, it would only be the interest, not what is affecting the balance sheet. So, does that answer the basic question about calculating value, though? The value of a business?